Hey guys, Brian Albridge here with Fairway Home Mortgage, SVP of the Reverse Division. Wanted to share a real life case of a borrower who came to me when they were 62 and they had started making money later in life. So they wanted to chunk down their current mortgage. They were in a 30-year fixed. He wanted to jump into a 15-year fixed. He only had a couple $100,000 in retirement accounts, but he was making good money. He's a consultant, so he's going to be able to make money for quite a while. But he did worry about what happens if something happens to him. He has a stroke, needing long-term care, something like that. He was worried about his wife. What would happen to her? She was a stay-at-home mom. They were in a very nice home. It was the family home. So they wanted to stay put because that's where everybody came to see grandma and grandpa. So anyway, here they are at age 62. The home value is a little over $1 million. If we did a reverse instead of a 15-year fixed, they could pay off their current loan, which is about 290 and change. And they, with closing costs and so forth, they'd have a new loan balance of 323, and they'd have a little line of credit of $38,000. But what we were going to do is have them make payments as if they were doing a 15-year fixed, the principal and interest payment, which were $2,752 when we did this a couple years ago. So if we're making payments, and as a reminder, the HECM reverse, most people choose the line of credit. And so if you make payments dollar for dollar, your line of credit gets bigger. So look what happens. In year two, their line of credit is 75,000. Their loan balance went down to 311. Year three, line of credit's 114, and so on. So at age 69, they have a line of credit of $354,000. Loan balance is down to 220. If something happened to him, let's say he couldn't work anymore, they can literally stop making those payments of $2,752, and they can again stop making payments, but they also have that line of credit of 354. Now if they continued to go until he was, say, 72, now look at the line of credit, it's $540,000. They only owe 159. He can stop making payments, but in this case, let's just say they go all the way till 77. They've made payments. They now have a $947,000 line of credit. And I've used 2% appreciation factor in this case. So the house is worth 1.3. They have a line of credit of 947, and the loan balance is only 26. Now, if they just stay put, don't make payments anymore after they paid off, look what happens. Because it's a non-recourse loan, the line of credit actually exceeds the value of the home in these years ahead. So at, say, 92, they have a line of credit of $2.6 million in the house. In this case, appreciating only 2% is 1.8 million. So now they could draw it all out because it's non-recourse. Nobody's on the hook for anything owed above and beyond 95% of current market value. Anyway, I'm going to attach the PDF with this showing the amortization. Hope you find this useful as a reminder that you can make mortgage payments with the reverse, and it creates quite the line of credit that can be used. And as a reminder, when you do use the line of credit, it's a reverse, so you never have to make payments. So, which is quite a nice, safe feature when people aren't working anymore. All right. Hope you have a great day.